Good morning. My name is Scott Forsino. I'm an associate broker with Real Brokerage, LLC, out of New York City metro area. I founded PlugIntro so real estate professionals can meet who they should know and can assist others gain local exposure. I have with me today Jason Ramirez, who's a definite expert mortgage professional. I want to hear some of his continuing thoughts in his interview series of the state of lending. It is now almost March 2023. We've gotten crazy 2 months into the year, and where we are, where we're going, and how Jason works with clients and referral partners. Thank you, Jason, for being here.
Good morning, and thank you for having me once again. So
this is your show. It's PlugIntro Ramirez.
State of the market, yeah.
So what's going on? I mean, what rates are? I just heard a tiny bump up.
Yeah, so you had obviously inflation numbers ticking higher month over month, but this is to be expected. The consumer, there's like an interesting dynamic going on. The consumer is just hot and strong right now, and the Fed obviously has been going through these hike cycles, and they've been getting they've been pretty aggressive. If you just look at prime rate alone, it's like 7 3/4 right now. 7.75 is prime rate alone, which is insane. It was half that just a year ago. So you have inflation kind of really ebbs and flows. In my opinion, it is trending lower. You're going to have pockets of popping in it, but it is trending lower. The market just responds very sensitive to any type of news, and treasury yields, something that I follow very closely, treasury yields and mortgage-backed securities. That's really my game. And I 3 weeks ago, we hit a low of 3.38 on the 10-year treasury. And just yesterday we hit 3.94. So there's been such volatility in these treasury yields. So that's the news that's really impacting these mortgage rates. And these inflation numbers, depends on who you talk to, pretty, not pretty, or expected, not expected. In my opinion, we are trending lower, long-term trending lower. You can see that clearly. And the housing market in itself, I believe, is starting to kind of find some footing because rates aren't as aggressive as they were just last year. Last year, we went from, as low as 3% on the 30, I'm going to use the benchmark 30, to as high as 7.5%. I think they found some footing and some stabilization. And with that, you're starting to see some activity flow back into the housing market. I know that just simply by pre-approvals coming in. I've had a couple of dozen come in over the last couple of months alone. That means interest is really starting to pick back up. And I think the new norm in these rates, 5-6%, if you do the 30-year fixed, is kind of becoming the benchmark right now, and which is fine. I think I've said last time, if the rate is going to be 7%, let it stay at 7%. Activity will formulate around 7%, but you can't go from 5% to 7% because people get this sticker shock, and it kind of really stops the market, which is what you saw. And you're starting to see activity pick back up because rates are stabilizing to some degree.
Mm-hmm. Well, I mean, as a realtor, I know then people in my team, Real Broker, some of the colleagues, you make that point you just made that really hit me, because if it's 5, if it's 6, I mean, how could you be looking for a house within your price range, which you don't have a price range, right? The house that you were looking for 650 at let's say 4.5% is certainly, you're not buying a 650 house when it's 6.5%, right? No. So, I mean, how can anyone maintain a stable search when their affordability, fluctuates? And that also, to me, points out a real weakness, because that JetBlue costs $300 round trip from, let's say, New York to Miami. That's there. But the seller's agent does not know that the buyer just fluctuated between okay and not okay. I mean, imagine the day you make the offer or the day you're looking. Imagine the buyer's agent has to look at houses in huge price ranges based on volatility. That's to me unheard of. It used to climb or decline, but not this zigzag like a heartbeat.
That's why and you hit it again. You hit it right on the head. That's why the volatility is not good, because you get a sticker shock and nobody knows what the hell to do. If your price range is 650 at 4% and it dips to 600 because the rate is 5%, then let it. If the rate stays at 5, then you can navigate your search based around where it is. And if it move, you have these incremental moves, you'll have 5 1/8, 5 1/4, whatever the case may be. It's fine. You're not going to have that much of a price disparity there. But if you go from 5 to 7, you take it. People they don't know what to look for. I'm a big proponent of, you need to keep updating your pre-approvals constantly. You can't sit on it. I've been seeing people sit on pre-approvals. Oh, I got pre-approved 6 months ago for XYZ. Well, that pre-approval might as well be on the mystery channel. It's no good. You need to really know where you stand now, and you have to keep updating. You have to know your buying power. That being said, the people like me, it keeps people in my I continue to interact with people, and I continue to gain their trust and confidence, because I can navigate them through these waters and kind of show them how the markets work. The longer I have with somebody to speak, the longer I have to speak to that person, I can really get them in my my financial ecosystem, so to speak, and get them involved in as to how I view things. It's worked for quite some. It works.
But even as good as that is, you're talking about all pre-contract where there's no obligations. Now we're just talking about a buyer's choice and a seller possibly, their interests aligned. But what happens when you're in a contract and now there's real big obligations? There's a risk of a down payment. There's the sellers, that house is off the market. They're incurring an implicit and inherent risk. Everything is really up in the air.
And the rate goes up. You mean and the rate goes up, and they don't.
And the rate goes up, and then DTI, and then I think our viewers know debt to income, how people qualify. We don't need to go to 101. Right. But now the seller's buying. Mr. Mon Pa Kettle are buying in Arizona, and then there's a family that it's like a crazy domino. I mean, you need some real professionals on all ends.
I mean, in a volatile market, you should lock your rate as soon as possible. I have loan officers constantly asking me, should I lock? I'm like, you just lock, call it a day and lock. What if the rate goes down? Then it goes down. Then you deal with it if it goes down. You're either going to have a conversation about, can I get a cheaper rate, or now I can't afford this property because the rate is too high. You have to pick your poison in that regard, right? So, when you go into contract, if you're comfortable with that price point and you can qualify right then and there, just lock the rate and call it a day.
Okay, so let's talk about that, because that's always been an interesting subject to me. Lock the rate is how long? 30, 60 days?
Well, you can go as high as 120 days, right?
Okay, but that's cases, rare. So the usuals are 30, 60, right?
60, 90, 60 being the benchmark.
Okay,
because
so 60.
Usually you get them closed within.
Okay, so then someone's running a risk there. The bank could get beat, or the buyer could lose unless can they pay to extend that rate lock?
Oh yeah, you can pay for extensions. That's obviously you would discuss the finances involved in that. Should it go past the contract date? Who's going to be responsible? Is it going to be the buyer's responsibility? Is it going to be the seller? That in that case you have a conversation with, if it's going to extend beyond that, I'll have a conversation with the customer and the attorney. Specifically the attorney, because he or she's got to deliver the information. Say this is the financial obligation of carrying it past this point, assuming it's not my buyer's fault.
Right. Well, okay, you bring that up, and the problem with a real estate contract is everyone is different. And what if you have a rate lock of 60 days and the seller discovers they have an underground storage tank, which has nothing to do with the buyer? They don't know about it. Then they have the right to take tests. And can you really what's the word? Can you rely on an environmental company coming in and doing this huge effort on time? Can't control them at all when they come, when they finish.
You could only control what you can control. If you're a seller and you have a tank that you weren't aware of, that's another conversation. That's another conversation altogether.
But what if you were aware? Then it doesn't make you a bad person. The buyer had the right to do some inspections, and they might have missed it, and they now have a rate lock issue. What if it becomes so bad that there's a denial?
I mean, you can play the market daily. The rates don't go up drastically overnight. They do tend to go up fast, but they don't go drastically overnight. This is where, my strategy in watching treasuries and how they trade, if today is uneventful, you can let it ride for a day. Boom, tomorrow, uneventful, let it ride for a day while people are doing their thing with that tank or whatever the case may be. You can kind of play it. Then there's, then I see volatility in treasuries. I say, all right, let's take the lock. Let's do a 90-day lock. And then we'll extend if we have to. If we're being completely honest, like there should be no reason, where the market is not as insane as it was a year ago, 2 years ago. So getting stuff done in a reasonable time is very manageable in every regard, in every part of the transaction.
Let me ask you, a little bit of some points about you. Do you think that loan officers or even organizations, companies, look at these indices like you do? Can we be honest here? Do you think some of the people, the social media superstars, even have the knowledge or the interest or the habit of following the market like you do?
No, I don't
either.
I don't think, and I was at Washington Mutual, Wells Fargo, and now Citizens Bank. Prior to that, Wall Street. And in every bank I've been to, I've seen, I've made a lot of good friends, but a lot of people have no idea what they're talking about. And when they look at markets, I've heard certain loan officers say, hey, this is the rate, and I don't know if it's going to go up tomorrow. I don't, how are you advising people?
I don't think they are. I think what you just said, I'll be more frank as an associate broker, because you have to remain humble about it. No realtors know what you're talking about. And I would say that nearly no loan officers, those that are not seasoned at all, not only don't do what you do, they don't grasp the concepts of what you do. They would not be able to, they don't have the acumen. They don't have, maybe didn't study as hard, maybe are unaware, maybe they weren't properly trained. Maybe, they use the spaghetti model. You know what that is?
Yeah.
Throw it against the wall, see what sticks.
Yeah, this is a byproduct of, there's no college degree to do what we do. It's really a byproduct of that. It's really, our business, mortgages, anybody can do it, but it's not for everybody, so people, you can literally walk in off the street and do this business, and then you can be the smartest person on the planet and just not be able to sell anything, water to a person walking in the desert, so I think you really need to understand how these markets work. And if you have an understanding, you could explain it easily. Like I believe Einstein once coined the phrase that, if you can't explain it to a kid, then you don't understand it enough. So, and that's in any topic. I try to really simplify it to a point, because I do understand it, and just because I watch it all the time.
Yes, you could see it. Your videos and, being connected to you personally, you see who really is drunk with mortgages. You see who's drunk with whatever their, passions are, who's, whether it's, you're running, or people with family, or people with an activity or a belief system. You can see those people that just are, they're ruled by their passion. They're prisoners to their cares. But I want to talk about the thing that, because rates moved, there was this sexy subject that was really becoming a copycat a few months ago, with the 3-2 buy down. And I want to hear what you think about it. And I'm going to tell you, my belief, because no matter what happens, realtors go first. Realtors go
Right.
first and then refer, and then mortgage guys, even if they've been pre-qualified or if it's your best friend, it doesn't correspond to a house. It exists in a vacuum or in the abstract. In your case, you could talk to a mortgage guy all winter and then they find a house. Yeah, but now we're talking about this house. What can be done better, do you think?
Well, the 3-2-1 buy down, you're basically kicking the can down the road. Obviously it's 3% lower than the proposed rate, then 2% lower than the proposed rate, then 1% lower. So, I see that as no different than just paying points and just buying down your rate permanently, or going after an arm of some sort. There are other ways to do it that are not as complex and as crafty as the 3-2-1 buy down. I've tell you the truth, I've been approached on it quite a few times, and I've given customers other options, and they've opted for those other options. I think ARMs, adjustable rate mortgages, are the king, or the yet to be crowned king product in this type of market. Nobody rides out a mortgage past 5 to 7 years anyway. So what's the point of taking a 30? You can go after these shorter term vehicles. If you want an even cheaper rate, pay the points on that. Like, you can still get an ARM. If you get a 10-6 ARM, you can buy that rate down into the low 4s, high 3s. What's wrong with that? And that rate is fixed for 10 years. What if, what if it will happen? There will be another cycle in rates. That is the natural course of business. There will be another cycle. Rates will cycle back down. The Fed can't hike forever, and these yields can't rise forever. They will balance out to some point, come back down. Will create more opportunity. You can refi out of it. There's a lot of ways to do it. I think ARMs are in my opinion, are the product of choice.
I want to say, nobody is talking about ARMs. Jason, nobody is talking about ARMs.
It's the craziest. It's so mind-boggling to me right now that nobody, because the thing with an ARM, and I hear it, is, oh, your rate could adjust forever. Like, what? Like, I like, who are you speaking to? Like, it's just like that's not what happens. That is not even close to what happens. That's, when people hear ARMs, they hear adjustable rate mortgage, and right away, oh my God, I'm in a rising rate environment. No, that it doesn't make sense to me. If you properly explain an ARM, people tend to really gravitate in that direction. I explain them in ways where it really does give customers pause, and they're like, you know what, maybe this is a better idea. And I do a big percentage of my business are ARMs, specifically 7 and 10 year ARMs. Statistically, nobody rides out a 30-year fix anyway past 7 years. That's math. I didn't make it up. That's just math. You can research that. And even in certain cases, even less. Now, with rates being so high, can that change? Maybe. But we've only been in this cycle for about less than a year, and rates are starting to stabilize again. So, an ARM is the way to go, and you can even buy it down. You forget your 3-2-1 buy down.
So
you can buy that right down.
Okay, so you brought this, kind of curveball to this conversation, which I'm really happy, because it takes one of my belief systems and expands on it. So I've been hearing the 3-2-1, and correct me if I'm wrong. I know it's underwritten. The loan is underwritten at the current prevailing market, and then based on the points that are paid by the seller, that is assumed, meaning no one asked the seller yet. So that's kind of crazy. So on social media, I'm hearing mortgage guys talk about a 3-2-1 loan without considering all the friction. Think of the friction. The buyer's got to want it. The buyer's agent's got to believe in it. The buyer's agent has to explain it to the seller's agent. The seller's agent has to explain to the seller while they're getting other offers that doesn't ask the seller for a dime. It has to be 3 steps: first base, second base, third base, and home plate is the seller that says, what? I don't want to pay anything. There's all these other people that don't want a thing from me.
Yeah.
So there's that. And then there's all that friction that nobody talks about. And that's the first thing. The second thing is, let's say that year 24, 36 months later, you're going to have 2 kinds of sticker shock. One, your escrows are going up in this world between taxes and insurance. Mm-hmm. So that means your payment overall, your pity payment, goes up more than you actually even know. And then what if in those 2 temporary years you eat too much sushi or buy too many nice clothes or go to Disney each year? You're living better, you're beyond your means, and then boom, it crashes down with an even higher than the pity payment you thought of today. So how many people with a high debt to income are really going to be in a problem zone in 36 months?
Yeah. I mean, look, I applaud the creativity, but in my eyes, you're creating a problem disguised as a solution. And it's not, it doesn't make much sense to me. Just if you want to get creative with that, present an arm. Your rate is fixed for a decade. We have a decade to figure it out if we want to refi out of it, or in the event that it adjusts, here's your adjustment numbers. This is what you'll look like year 11, 12, 13, 14, and so on and so forth. In my eyes, cleaner, easier to explain, much easier to explain. And there is no, after the first year, now it's 2% less than the prevailing rate.
Okay, but let's continue that. Let's continue that. We agree that there's a lot of clunky moving parts. Mm-hmm. And the last part to slide into home base is getting the seller to pay money. So that's a tough nut in my mind. That's a tough thing to do. Okay, so yeah. I have an idea where this is called marketing, where you as a lender can work with agents to make them better. And I use the C word, collaboration. I don't think this environment can any longer be adversarial or even stay in your own lane. I think everyone has to lock arms to get stuff across. Now, of course, historically, a buyer gets in a contract, a seller sits back, they're the buyer's mortgage. When it's always been my belief, and it's never been important, that the seller controls the buyer's interest rate and their monthly payment to make the property, by paying points, to make the property more available and, more important to the seller, more marketable, more sexy. The realtor can represent that this house will come with discount points, so whatever the buyer qualifies for, they'll pay less, which means the houses in your market, if you're selling a $500,000 townhouse in Phoenix, they're identical, they're cookie cutter, your house comes with a lower payment. And now you're introducing the adjustable, so the listing agent can even take further control and say, listen, I have the idea of, if you use this arm, we'll pay towards that. So it's dramatically different than a conventional without a discount points. Now you're talking about really next level positive change.
Mm-hmm. Yeah. Yeah. I mean, again, like I think these are the options that should be presented. You got to give more than just that. And, to your point earlier, asking a seller to kick up for a cheaper rate is never the easiest thing in the planet, especially since, it's becoming more evident, that in certain markets, they're going to probably have to price reduce as is, or balance it out to try to spurt more interest. So yeah, I think it is a great idea.
right.
give
And
them that. You can
let
give
me
them the
address the
rates you
dis.
want,
Let
and you
me.
can give them that.
I love that you said that price, because let's say the house is 500,000. I check MLS almost daily, and there's red everywhere. People, now just think about it. You bought the house in 2011. Now you want 500,000. You know there's a lot of money there. So when you reduce it 5%, the realtor says you got to reduce it 5%. That's 25,000. That means you're taking monopoly money, digital money, fake money, because it never was 500. If you have $500 cash in your pocket, and I say, give me $25, Jason, that's $25 of your money. You had it in your pocket, and now you're giving it away. This is $500 of fantasy money. It's not real. You didn't get it. It's still, it's aspirational at best in this market. So why not forget about taking that 500 away? Why not push that across the table and say this 5%, what otherwise would be a price chop, will go towards the buyer's discount points. And if I'm right, you'll tell me usually about 4 points will pay down 1 percentage rate. Is that right? Really kind of 4-to-1 ratio?
You could look at it about that. Yeah, that's about right. Yeah.
Loosely.
Yeah.
Let's call it 5 to whoever. Maybe it's 0.75, but it certainly is much less than the buyer's willing to pay. Buyers, do buyers pay 4 points ever?
I don't think you can't. You can't.
Okay, so in your experience, I don't mean the bad old days. In the current world, do buyers ever pay 2 points?
Yeah, I did a monster loan one time and this was early last year, for a customer who paid 2.87 points just so that
but that's a monster.
Just so we can get his rate to 1.75.
But aren't everyone, their rally cries, no points, no points. What's the rate? No points. That points became a bad word.
Points became a bad word for the people that don't know how to sell the value of paying points. That's another conversation altogether.
Right, and that's so. I mean, every advertisement is this rate with no points, because points became the bad guy. Let's avoid the points and let's just make it.
Yeah.
Right, got it. So now you're in a market where no one is taking advantage of the opportunity from the buy side, and the seller can take that choice out of the buyer's hands. Imagine if I could sell you a gallon of gas for $1.50, you would have no choice but to come to my gas station.
Correct.
You'd be a fool to go across the street, pay $4. Well, now a seller can do that. And that means it's your job to show that agents that work with you have this type of insight and this type of approach, strategy to implement change. You can make 2 things happen: listing agents be the most desirable out there, and houses be the most attractive opportunity out there for buyers. So it's amazing.
Yeah, it's just you have to have a knack for bridging the gap, so to speak. There's always a gap somewhere, right? There's always a disconnect's a strong word, but there's always some sort of a gap.
Avoid, is that the word? Avoid.
Yeah, void.
There's a void. There's an opportunity.
Also, but there's a little gap there, right? And I feel like I have the ability to bridge that gap. I just have to know. I have to be involved. Agents that I work with know how to bridge the gap because they speak to me all the time.
I understand.
And I can give them ideas on how to bridge that gap. Sometimes it works, sometimes it doesn't, but it gives people something to chew on and think about. But bridging the gap is very important. That's what I think a lot of loan officers can't do, or don't have the ability to do. I don't know, but I can definitely get creative. I can show you how to bridge that gap, and that's what's important. For starters, people need self-awareness. Like, where are we with the price of this house? Is it real? Is it not real? Like where are we? Is the seller well advised? Is the agent just throwing it out there just for a big, everybody's got to be involved in bridging that, got to want to bridge that gap. I could.
Okay. So, I mean, but
make everybody understand
the way you are, the way you are in a t-shirt with your blinds in the background, and you're very, very confidently explaining the implementation of this approach, there are people that are unwilling to utilize any unorthodox approach because they don't want to be an outlier. They don't want to be someone weird. I've had brokers in a deal I did last summer where we were doing exactly this. I told my client, forget about price chopping. Let's push it across the table. And I had people telling me, the buyer's agent, no, we just want to do a straight deal. And I go, wait, a straight deal? Your buyer wants the highest rate there is. Yeah, we just want a straight deal. And I had to call the broker, her broker, and say, this is what's going on, and I'll get back to you. Guess what? We went with someone else. So that person, that agent, never gave the buyer an opportunity to save on this house or another house.
People fear the unknown.
And never gave herself a chance, because they're unaware. They're not knowledgeable, and they're unwilling to look bad the way you're not.
Well, look, thank you for that. And I'm not afraid to put myself out there and explain it to people. People don't want the unknown. They're scared. They look at stuff like, I don't get this and I don't want to do it, because maybe they don't want to look like they don't know what they're talking about to their seller. I get it. I get that. They don't want to look foolish. But that's a slippery slope. I'm not, for myself, I'm not that, that doesn't bother me, because even if I don't know certain products, I'll give you what I know, and I'll try to bridge the gap, is really what it is. I'm not afraid to look foolish. I'm just not afraid to look foolish. And I try not to, by the way. I do my best to really put my best foot forward. But to your point, people will lose business just because they're afraid of the unknown. If it sounds too complicated, they don't want to do it. Like,
well, they also,
that agent said straight deal. Like, what does that even mean? What does that
mean?
It
means no collaboration and no innovation, and we do it like it's always been done. And
I'll give you a suitcase of money and you sign over the deed to me. Like, that's about as straight a deal as possible. I don't know.
I've had, I'll even knock some of my realtor brothers and sisters. The famous words that realtor says, I never heard of that. But realistically, do they have their nose to the grindstone? How could anyone be as well-versed as you are, who's watching the markets and is really interested in delivering that message? No one does this. Even mortgage guys don't do this.
No. It's unfortunate. I wish, I'm actually not, I wish, I'm happy people don't, because it helps me. Right. It really does. When I hear some of my competition speak, I'm just like, thank you. I thank them. Just thank you for being you. Just because you make it easier for me. But I think this is what I present to customers. I think it's a prerequisite. I think everybody should know this in my line of work. These are just things you need to know.
I'll tell you, I think what you're talking about with regard to a customer is someone who's signing the loan app. I think that a great play to generate trust and reciprocal relations is for you and all mortgage guys who want to take this approach, is to talk to realtors who do not have any deals, because some or most will one day have a seller. You can give them this superpower, how to co-present in a listing presentation, that you and that listing agent have something that no one else has. You have a solution for their sale and their buy. And if you hire Sally or Rob from Coldwell Bank or Century 21, you don't have that. This is an opportunity for you to really, really empower an agent to stand really out in their field. We're not talking about professional photography, staging, social media, Zillow. We're talking about how the house can be more affordable, and therefore increase the demand and therefore get the best possible price. So I think that's your move, and with agents, and we're here to help, is to put you in a place where you're really giving education to agents when they encounter their next seller, and equip them to get that client because they're the best able to serve them.
Yep. Yeah.
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 That's
I would need a forum of fresh agents, and I can, I can give them all.
Well, we know agents, what I love about agents is they're everywhere, from sea to shining sea. They're every zip code in America. You'll find agents. I've looked into the deepest crevice in Alaska. They're there. I've looked in the deepest mountains of Rocky Mountains, or the farthest section of the Everglades. There's realtors there.
I mean, like I said, the business of real estate and mortgage is super lucrative, and anybody can do it, but not everybody can do it, so it's really it's a play on words, but it's true, so it's not a first choice business, but it's lucrative.
It's a great way to help people.
Yes, 100%.
Yeah. It's a real way to positive. You can influence people, create generational wealth, put them in the school system of their choice, give them options they never would have otherwise had, and give agents a decided advantage over their competition just by working with someone like you or you. So let's do that. Jason, thanks a lot. What's the best way to get in touch with you?
You can get in touch. You can just email me at, jason.ramirez@citizensbank.com. You can call me. You can look me up, The Mortgage Runner, on Instagram, or just Jason Ramirez Mortgage. I mean, I'm everywhere. If you Google Jason Ramirez Mortgage, my picture will pop up. I'm the first hit. So there's a lot of ways to get to me.
Great. Okay, let's act on getting those agents a little bit better served by working with you.